Just check the IronFX.
Yeah.
Have fun.
Okay. All right. Hi, everyone. Welcome to today's webinar brought to you by IronFX. Today's webinar series is going to be on breaking news and setups. So we've had the FOMC meeting yesterday on 31st of January, right? We saw a very uh, pretty hawkish statement by the FOMC as well as Jerome Powell during his press conference as well communicated a very pretty hawkish tone as well, pushing back against aggressive interest rate cuts. And many market participants were expecting interest rate cuts to begin in March, but after today's, or rather after yesterday's meeting, uh, Chairman Powell, along with his fellow FOMC members, have come out to push back against this initial rate cut, right? So they're going to keep interest rates a little bit higher for long, or well, rather they're going to maintain the Fed funds rate at the current level of 5.25 to 5.5% for a little longer than originally anticipated. All right. Okay, so before we start things off, let's just go through the disclaimer and the risk warning, right? Do take note that all the products are carried on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. Also, do take note of the disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Right, so my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, sure. Here's the agenda for today. We'll look at the key economic events that were up this week. This week, actually, there was a full calendar, but of course we will not be able to go through every single news event. We'll just cover some of the more important ones. So like on 31st January, yesterday we had the FOMC meeting, the release of the statement, as well as Chairman Jerome Powell's press conference. So we'll do a quick review of that. Then we've got the Bank of England releasing its monetary policy report today, 1st of February. That's going to be at 12 p.m. GMT time. And after that, we've got U.S. unemployment claims as well at 1:30 GMT, 1:30 p.m. GMT time. And tomorrow is going to be the highly anticipated non-farm payrolls, right? Friday, 2nd of February. All right, so here's the calendar for Thursday and Friday, right? As you can see, it's a pretty full calendar. We had Caixin Manufacturing PMI earlier this morning. We've also got ECB President Lagarde speaking. Uh, well, what is it? Shori's had conducted a speech at 16 at 8 a.m. GMT time. We've also got flash CPI data for the month of January, I believe, for the EU area, for the Euro area. This is at 10 a.m. GMT time, so that's in about an hour's time. Then we've also got OPEC meetings all day, right? This could have an impact on crude oil prices as well. And at 12 p.m. GMT, the Bank of England will release its monetary policy report, and they'll also where they're widely expected to hold their official bank rate at 5.25%, right? So no surprises there. They're widely expected to keep their official cash rate at 5.25%. And then we have Governor Andrew Bailey speaking at 12:30 p.m. So his press conference is going to be closely watched as well. Right. Following on, we've got unemployment claims out of the US at 1:30 p.m. GMT, followed by ISM manufacturing PMI as well at 3 p.m. And of course, tomorrow we've got the highly anticipated non-farm payrolls and the unemployment rate coming up together with average hourly earnings. This is going to be dropped at 1:30 p.m. GMT time. And following that, we've got the revised or the final reading from the University of Michigan's Consumer Sentiment Survey, right? So that's going to be up as well. All right, so as you can see, it's a very heavy calendar, and which is likely to inject a lot of volatility into financial markets over the next 36 hours or so. All right, so let's just start off with a quick FOMC review. Right, so as you can see, the Fed funds rate currently stands at 5.25 to 5.5%. Right, this is the fourth consecutive meeting where the Fed has kept rates on hold. right? So, and policymakers have added that they do not expect it. It will be appropriate to reduce rates or cut rates so soon. Markets were anticipating interest rate cuts coming up in at the March meeting, at the March FOMC meeting, but it looks like that's not going to take place because the statement and Chairman Jerome Powell has pushed back against aggressive interest rate cuts, right? So the Fed is waiting to uh, to to gain more confidence and to be certain that inflation is moving sustainably towards their target of 2%. Right. So currently the core and headline CPI in the US is about slightly above 3%, if I'm not mistaken. Right. But I think it's about 3.9, 3.4 around there. So you can see that it's still quite a way from their target of 2%, right? And they're also concerned that although inflation has eased quite considerably over the past year, it still remains elevated, right? So there's still a lot of fear, or not fear, there's still some concern that inflation could spike its ugly head again, right? Could rear its ugly head again. So that's why the Fed is not going to cut, has signaled that they're not going to cut rates at the March meeting. They're likely to maintain rates at the current level for a longer period than originally intended. All right, moving on, we've got the Bank of England releasing their monetary policy report at 12 p.m. So similarly, they're going to keep it. They're very likely expected to keep their interest rates or their official bank rate on hold at 5.25%. Right. Similarly, um, although inflation has eased considerably in the UK as well. On the left, I've got the chart for headline CPI. On the right, I've got the chart for core CPI. So you can clearly see they're both well off their peaks and have eased quite significantly over the past year or so. But once again, you can see both indices are well away from the target of 2%, right? The Bank of England has a similar target as well. Their inflation target is about 2 to 3%. And as you can see, both the headline and the core readings are quite a far distance away from their target of 2 to 3%. So hence, the Bank of England too is not expected to cut rates anytime soon, but they're more likely to keep them at whole at 5.25%. Looking over at economic activity in the UK, on the left, I've got the GDP growth rate on the Q, quarterly basis, right? Quarterly basis growth rate. And on the right, I've got the composite PMI reading. So you can see GDP growth in the UK has been quite anemic over the past almost 2 years, right? And but we've just seen composite PMI return into expansion over the last 3 months as well. So we've got weakening. We've had almost 18 months of weak growth in the UK, but the recent PMI data does seem to suggest that economic activity or output could pick up in the fourth quarter of 2023. So because the economy is quite sluggish, of course, the Bank of England is not going to raise rates anytime soon, but they're more likely to maintain rates at current level so as to try and bring inflation or try to bring inflation down or push inflation down closer to their target, as well as try to keep a balance between uh, keeping economic activity afloat. All right. Okay. So do take note. If the statement and Governor Andrew Bailey's press conference turns out to be pretty hawkish, this could potentially provide potential bullish catalyst for the pound as well. So, right. So do take note, although the Bank of England may not raise interest rates, but the tone of the report and the tone of Governor Andrew Bailey's press conference could provide a much needed lift for the pound, right? Okay, coming up after that, we've got unemployment claims in the US at 1:30 p.m. GMT time, right? So unemployment claims basically measure the number of American citizens filing for unemployment benefits. So if we see a number that's higher than the forecast, that means there's more people filing for such benefits, and it could uh, signal a potential weakening in the US labor market. So what we saw last week was we had claims of 214,000 versus the estimate of about 190 I believe. So claims came in higher than the uh, forecast. So this usually functions as a bearish catalyst for the dollar index. Right? As you can see, since over the last 8 weeks or so, last 8 to 10 weeks, unemployment claims have been trending lower. So when unemployment claims are trending lower, this signals a robust labor market, and thus it would typically function as a bullish catalyst. However, we saw last week's number come in quite strong, and should we see this tonight's number come in higher than the forecast of 213,000, then this could then potentially cause the dollar index to fall. So how can we interpret this data? So do take note, this week's forecast or tonight's forecast is for 230,000 claims. So if the actual number comes in greater than 230,000, then this is typically going to be bearish for the US dollar. So that would mean currencies such as the euro, the pound, Aussie, Kiwi, and gold will rise. Conversely, if claims come in lower than 230,000, that means there are less people filing for unemployment benefits. So this means that uh, uh, the US labor market is still relatively robust. So that this would be bullish for the US dollar, which in turn would cause currencies such as the euro, the pound, Aussie, Kiwi, and gold prices to fall, right? So this is how we can easily interpret the data and what we can typically expect to happen, right? Do take note, just because claims come in higher than 230,000 doesn't mean that it's it's uh it's 100% certainty that it's going to be bearish for the US dollar, but typically this is how it would uh, impact the direction of the US dollar, right? So do take note of how uh, the data could push the direction of the US dollar or the dollar index, and also, of course, do take note of price action as well. Sometimes price action does not conform to the actual data. All right, and coming up tomorrow, Friday, 2nd of February, we've got highly anticipated non-farm payrolls, right? They're going to be released at 1:30 p.m. GMT time, right? So last month's figure, sorry, which was not last month, sorry, the previous month's figure was for December, right? December's reading came in at 216,000. You can see this October, November, December. December's number came in at 216,000. January's number estimate is at 187,000. So you can see the non-farm payroll has been quite relatively soft compared to the early parts of January, right? End of December or end of 2022, early Jan, we had sort of strong numbers, but for most parts of 2023, numbers have been averaging about 220,000, 240,000 a month, right? So naturally, by this stage of the cycle, we can expect hiring to slow down, right? So we are not expecting tremendous job growth every month, but at least jobs are still growing, right? So if we get a data that's going to be lower than the estimate of 187,000, then this could then potentially function as a bearish catalyst for the dollar. Similarly, we are also expecting the unemployment rate to edge slightly higher from 3.7 to 3.8%, right? So if you get a case where NFPs missed the estimate quite badly, and we also see the unemployment rate increasing to 3.8 or perhaps even 3.9%, then this is quite certain to act as a bearish catalyst for the dollar index. So that means currencies such as the euro, pound, Aussie, Kiwi are all likely to rise, and also we can expect gold prices to rise as well. Right. However, should the data come in stronger than anticipated, that means we get non-farm payrolls that comes in perhaps about 200,000 versus the estimate of 187,000, while unemployment remains the same at or matches the estimate at 3.8 or comes in a little bit lower than the estimate of 3.8%, then that could potentially function as a bullish catalyst for the dollar index. So do take note how the data could impact the direction of the US dollar once again. All right, so let's move on to trading view now, and we'll dive into the charts and see where the current resistance and support levels for the dollar index. We'll do a couple of the major currency pairs as well, like the euro, pound. Then we'll look at gold prices, of course, crude oil. We'll use WTI oil, and perhaps we'll look at the indices as well, right? If there's time. All right. Okay, right, great. Let's get on with it. So as you can see, generally, since the beginning of this year in 2024, the dollar index has been in a strong upward trend, but it's also been through periods of consolidation as well. So like we can see from 3rd January till 15th January, so for almost a period of 10 trading days or so, right? The dollar index was ranging approximately between 102 and 102.80 roughly, right? And then after that, it broke out of this consolidation range to go higher, climbing as high as 103.60. And then again, since then, since 17th of January till now, which is again another roughly about 10 trading days, it's ranged approximately between 103 and 103.80 as well, right? So you can see it has been consolidating within this range, and it has just broken out of this this original resistance at 103.65. Of course, now the current resistance is going to be over here, right? Sorry, yeah. So the first resistance for the dollar index, right, is at 103.81, right? We can see price reacting of this level multiple times, right? We see price reacting of 103.81 on 23rd of Jan. Oops. 29th of Jan, as well as on 1st February, right? We can see 3 instances where prices reacted of this level quite strongly, and it's a level which has yet to be broken, right? So this does signal to us to be a very significant pullback resistance, and that's why we've identified it as the first resistance. Right. Similarly, when we're looking at the next resistance level that comes in at about 104.26. Why is that the case? Because you can see price making a pretty significant swing high back on 11th of December, right? This is a pretty decent swing high resistance here. Price failing to break above this level at 104.26, right? So that is how we've identified the second um, resistance, right? So even I can stretch it all the way till here, right? And you can roughly see pretty much since 6th of December, this level or this zone has acted as a pretty strong resistance area for price, right? Right, there we go. See, so we can see that this uh, zone between 104.20 and 104.27 is indeed a pretty significant resistance zone. So should the dollar index be able to break above this zone here at 103.81, then we could see it rise towards here. Now, what could cause the dollar index to go higher? Right, so a couple of combinations, where we have unemployment data claims coming up today. So if that data comes in lower than the estimate, that means the US labor market is still pretty robust. And also, if we get a strong NFP print tomorrow and unemployment stays relatively stable or perhaps even inches lower, then these are all elements that could create a strong bullish catalyst for the dollar index. So that means we could have a scenario like that, and that could potentially cause the dollar index to break above 103.80 and then make a move towards at least 104 and to 104.80, right? At 104.20, right? So do take note of that. Okay, to the support side, right? I see a new first support here at about 109.98, or so basically about 193. So I'm going to identify this as my first support level here. Right, we can see price has bounced off this level on 23rd of Jan, 24th of Jan, and of course on 31st of Jan as well. So similarly, it has bounced off this level several times to indicate that this is indeed a pretty significant support level. So this is a pullback support level at 102.98, which we've identified as our first support. Right, of course, we also have run the Fibonacci retracement here. This was in the past, this was back last week. So if we look at where this retracement should now end, we're going to look for a new high. The new high, let's see, where is it exactly? Is it here, 23rd of Jan? It does seem like it's going to be on 29th of Jan, right? Yep, 29th of Jan is indeed the new high. So let's pull up all the fibs. Let's see what we get. Okay, so price has already reacted off 23.6% once here, right? After making this high, price came down, did find strong support around this zone. So let's just highlight it as a zone rather than an absolute level. Right. And of course, when we look at the second support, or when we look at this level at 102.76, this is also another pretty decent overlap level. So let's just highlight this as our second support. right? We can see price running to resistance here on 3rd of Jan, 5th of Jan, 11th of Jan, and you can even argue here that on 24th of Jan, price found decent support just above this level before climbing higher, right? So we can quite confidently say that this is a pretty significant overlap support level at 102.76, and that's why we've identified it as the second support. And in addition, we've also got the 38.2% Fibonacci retracement aligned quite close to this level, so we can highlight this as a zone rather than an absolute level as well. All right, okay, so let's get rid of all the other Fibonacci retracements. We'll just keep 33 and 38.2%. All right. So, okay, do take note of that. All right. So, if we do, so do take note, this resistance and support levels are areas where you could identify potential entries and reversals as well, right? Because we see this level here at 103.80, prices fail to break above this level. So, should unemployment claims come in higher than the estimate, that's going to function as that's going to potentially function as a bearish catalyst for the dollar index. So, if that were to happen, you could initiate or open a short position on the dollar index, and where you would place your stop loss would be slightly above the first resistance. Maybe you'll give ourselves about a 10 to 15 pip buffer. That means we'll set the stop loss at about 103.95. And then should the data suggest that this is going to be bearish for the dollar index, we can initiate a short position with the stop loss at slightly above the first resistance, and we can target uh, the zone of 103.10 to 103 as a potential take profit, right? So do take note of that, of how we can use this resistance and support levels to help us identify suitable stop loss levels as well as take profit levels should price reverse from around 103.70. All right. Let's see. Right, similarly, okay, so this is what we have for the dollar index. Let's look at the euro. Right, so similarly, since the dollar index is at elevated levels, we can also expect the euro to be quite depressed, right? Which is what we see here, right? So let's see, prices just, well, not just, but yesterday broke under this first support at 1.0813. So let's try and identify a new support level for the euro. The second support is fine at 1.0743. It's simply this swing low, right? This is a pretty significant swing low that occurred here on 8th of December. And you can even see that this is pretty much like a double bottom before price bounced higher. So you can see why the level at 1.0743 is indeed a very significant support level for the euro. All right, so let's try and identify a new support level here. As we can see that this previous first support has been broken, which was also a level that aligned quite well with the 78.6% Fibonacci retracement. Now let's get rid of this retracement now because it's no longer valid. Right, where price could find the next support could be this pretty decent overlap level here, right, at 1.0774. This is not the best level, so perhaps I would like to this is not a very clean level here. I can see price breaking through this here a few times. So perhaps I would like to identify this as an intermediate support because I don't have a very strong conviction on the significance of the support level. And I would identify 1.0743 as the first major support, right? This was previously an intermediate support. We don't need that. This retracement can now be extended as well. Right, so let's pull up this retracement and pull up all the fibs to see if we can use any of the fibs to Fibonacci retracement levels to help us identify potential resistances. All right, so what we do see here, price running the resistance here on 31st of January at about 1.0860, right? This is a pullback resistance level that aligns quite well with a 23.6% Fibonacci retracement. We also see price running the resistance here again on 26th of Jan. This is another pullback, so we can use this level here and 1.0872 to help us identify a potential resistance level or zone. And combining it with the pullback here and the Fibonacci retracement, we can see that this is a the retracement, the pullback resistance zone starts from about 1.0864 to about 1.0872. All right, okay. right? For the second resistance, we can see price making another pullback resistance here on 24th of Jan, rising as high as 1.0924 before dropping, right? So we can see that this is a pretty decent resistance level as well, which also has the 38.2% Fibonacci retracement. So we'll use 23 and 38.2. Right, so this is what we have. So let's tidy up the chart a bit. All right, let's see. I think we can also use a Fibonacci projection. Projection involves 3 points. So what this projection could do is help us to identify or help us to add significance to the support levels that we have identified here. So this projection is going to start from point 1 on 26th of Jan, going down to point 2 on the 29th, and ending at point 3, which is at 31st. So we can see, all right, no, it is already price as price was falling down. It has gone through the 100% Fibonacci projection as well. All right, so we can't use this projection anymore because price has already broken through this level here. All right, so these are the key support and resistance levels for the euro. So should we get should we see demand for the dollar pick up later today during the US session, then we can use the support levels to help us identify potential take profit zones. So should we see the euro does, if we look on the 1 hour time frame, right? The euro did drop as low as 1.0780 the previous candle, but it's starting to rise quite high. It's starting to retrace higher, right? So should we see price uh, reverse once again and drop lower, where we could potentially identify a take profit level for the euro would be around 1.0773, right? When we look at the euro, it has been in a pretty strong downturn, right? Of course, there could be retracements to the upside. So these retracements could potentially help us identify potential bearish reversals as well. So let's do a Fibonacci retracement from this high here, 31st of Jan, going down to this low. Right, so we do see a pretty decent pullback resistance level here, close to the 23.6%. Right, so we could see price potentially run into a little bit of resistance around here at 1.0800. And we also see another decent pullback resistance where the 38.2% Fibonacci retracement level lies, which is at 1.0820. So we do see a couple of potential resistance areas to halt this this rise in the euro, right? So do take note, if price does stall around 1.0800 and starts to reverse, it could help us identify a potential reversal or potential short entry for the euro, and we can target the range between 1.0780 and 1.0775 as a potential take profit zone, right? Given the fact that the euro has been in a relatively strong downturn. All right, so let's look at the pound, since we've got the Bank of England coming up today, right? They are going to make their announcement in about what is this, 2.5 hours, right? So in about 2.5 hours at 12 p.m. GMT time, the Bank of England will release its monetary policy report, and then followed by the governor Andrew Bailey's press conference at 12:30 p.m. GMT. So do take note that there's quite a few things going on today as well. All right, let's just clean up the Fibonacci retracements for now. Right, okay. I think support and resistances for the pound is pretty much fine. Okay, support is fine. There's more actionable levels here. Resistance, I like to adjust my resistance levels to identify the current price action. Right. So if we look at resistances, we can see price running into resistance here on 29th of Jan, and again running into resistance around here at 31st of Jan. So of course the wicks have extended all the way up. Perhaps because of that, I would identify this as an intermediate resistance. Perhaps this would probably be better to identify it as an intermediate resistance. And the first resistance would come in here at 1.2748, right? We can see where price really failed to break above this level here, right? We do have the wicks going slightly higher, extending slightly beyond this point, but generally we can see 1.3750 acting as a pretty significant resistance point. Okay, so First intermediate resistance for the pound is at 1.2721. First major resistance is at 1.2748, and the next major resistance is at 1.2773. And you can see price making a pretty significant swing high here or a pullback resistance here. Now, price has tested the support level at 1.2650 several times, right? We can see that price has tested this level on 17th of Jan to 18th of Jan, 23rd of Jan, 30th of Jan, and of course, as recently as today as well. So you can see 5 times where price has bounced off this level quite convincingly, which tells us that this level at 1.2650 is indeed a very significant pullback support level for the pound, right? So if we do get a statement by the Bank of England that is that sounds quite hawkish, and we also see Governor Andrew Bailey communicating a pretty hawkish outlook or tone, we may see the pound reverse off this level to climb higher. So do take note how the upcoming Bank of England monetary policy report and press conference could potentially drive the direction for the pound, right? We could see the pound rebounding off this level to climb higher. So do take note of that. All right, second support is quite clear as well, right? We see price making a significant swing low of this level of 1.2609 on 3rd of Jan, and also making a strong rebound here on 5th of Jan, and of course on 17th of Jan as well. So we can see several instances where price has rebounded off 1.2609, which gives us confidence that this level here is indeed a very significant level. We can identify this level as a multi-swing low support, right? We can see a multi-swing three multi-swing low supports here, right? Oops, let me do that again. Wait. 1, 2, 3, right? So you can see 3 times where price has bounced off this level quite strongly, which tells us that this is indeed a significant multi-swing low support at 1.2609. All right, let's see if there's anything else. Is there any? We use a Fibonacci projection. Let's see. Let's try to see if any of these projection levels could add significance to the support. Nope, this doesn't make sense. So, this extensions and the extension levels. All right, we do see at the Fibonacci extension level at 137.2% to add a little bit more significance to this level here. All right. Okay, with that, let's move on over to gold, right? Let's move on over to gold. Let me see euro. How is it? Okay, yeah. Let's move on over to gold. Okay, so we can see this level here previously at 2039 was functioning as an intermediate resistance level. Price failing to break above this level on 19th of Jan, 23rd of Jan, as well as 30th of Jan. Of course, now price is clearly broken above it. And this was also a level that aligned quite well with the 61.8% Fibonacci retracement. But of course, we can't use this retracement level anymore since price has broken above it. Let's see if we can use the 78.6 instead. And that adds up to, yes, 78.6 does line up very well with this pullback that occurred here on earlier this week, right? Yesterday, right? 2049 pretty much. So we can use this level at 78.6% to help us identify an intermediate resistance level for gold prices. Right, no changes to the first resistance here, right? We've run another Fibonacci retracement from this swing high here on 28th of December, going down to the swing low here on the 17th. We can see that this zone between the 61.8% Fibonacci retracement as well as this overlap level here at 2059 has identified a pretty significant resistance zone for gold prices, right? We can see price finding support here twice back in, oh, hang on. Price finding support once on 29th of December, second time on 2nd Jan, and then after running into resistance on 5th of January as well as on 12th of January, right? So this creates an overlap level, which is acting as major resistance. And you can even argue that on 31st January, yesterday, price came quite close to this zone once more and got rejected again. So you can see that this price zone between 2055 and 2060 is indeed a significant resistance zone for gold prices. Right. And we also have the pullback resistance level here at 2049. All right, looking at the second resistance, clearly this is a multi-swing high resistance here, right? Price making a very significant swing high here on 4th of December last year, and another significant swing high here towards the end of December as well. Right, so you can see these 2 points are very clearly major resistance zones or points or levels, which is why we've identified 2087 as our second resistance. Right, okay, now looking down at support, perhaps we can use the Fibonacci retracement now over here. We'll start this retracement from this low here on 25th of Jan, going up to this high here on the 31st. Let's pull up all the fibs, see what we get. Oh, I think we can get rid of this projection. This projection is no longer valid now. Okay, let's tidy up the chart a bit. All right, let's see if there's any level that we could potentially use as an intermediate support. I think where the 61.8% is does look like to be where the 50% is does look like to be a pretty decent intermediate support. Let me just tidy things up, then we can see that more clearly. Right, so if you look across this price level here at 2031.37, this does look like to be a pretty decent pullback support level that aligns well with the 50% Fibonacci retracement, right? So we can see price bouncing off this level several times earlier this week before moving higher. All right, so we can see that this level here has acted as support. First major support at 2005 is pretty clear, right? This is a very significant swing low bounce. And of course, the second support at 1976 is also another very significant swing low bounce as well. Right, okay, so these are the levels here. So do take note, if we do see the data push the dollar index higher, that we may see gold prices drop as well, right? Typically, gold prices and the value of the US dollar have an inverse relationship. So that means if the price of the US dollar is falling, that means typically gold prices are rising, as what we saw here, right? From last week. But if the value of the US dollar picks up very strongly, or demand for the dollar picks up, then it's quite likely we're going to see gold prices pull back, as what we've seen here, right? From 15th of Jan till 17th of Jan, as well as 28th of December till 11th of Jan, right? So this is how the stronger dollar could potentially drive gold prices lower. And if it does break this intermediate support at 2031, it could trigger a move all the way down to the first support at between 2010 and 2005. So do take note, should gold prices break above this intermediate resistance here at 2031, we can target 2011 and 2005 as a potential take profit zone should we decide to short gold on this potential bearish breakout here. All right, okay. So this is what we have for gold. Let's move on to crude. We're going to use WTI oil and look at how oil prices are trading. All right. All right, just zooming out a little bit first before we look at the chart in a little bit closer. So as you can see, second resistance is at $82.67 per barrel, right? You can see price running through the resistance here on 1st of November and 3rd of November, creating a pullback resistance, right? We can see a pullback resistance here, and we can see a multi-swing high resistance on 14th of November, as well as 30th of November, right? These are very significant swing high resistances. So this tells us that the first resistance level at 79.39 is indeed very important, and it once again has actually impeded prices once more, right? We saw prices running into resistance here or close to this level on 28 and 29 of January, right? So you can see several times where prices has been halted around this level and proceeded to drop lower each time. So that's how we've identified the first and second resistance levels for WTI oil. All right, then let's move down closer into the support. So now we can zoom in. Right, we can see this level here at 75.24 is a pretty decent pullback support level. right? Price has run into resistance here on 12th of Jan, and again on 22nd of Jan, creating a pullback resistance level. But of course, with price breaking above it now, this level could now then potentially function as a uh, pullback support level, which does seem to be the case, right? Since 31st of January, yesterday, price has failed to break under this level for now and has looks like it's going to retrace higher. So we also see price being supported by the bullish Ichimoku cloud, right? We see price being supported by the bullish Ichimoku cloud. So potentially we could see gold prices, WTI prices rise higher. And if it breaks above $77 per barrel, we can probably target a take profit zone at about 77.82, right? 77.82 could be a potential take profit zone for WTI oil. Especially if it continues to rise higher. So you can see, right, we can use this pullback support level here at 75.24 to identify a potential stop loss level, right? You can put our stop loss probably about 25 cents underneath this level. So you set the stop loss dead set at $75 per barrel. And with prices bouncing off the bullish Ichimoku cloud, it could potentially rise towards 77. And if it does clear 77, it could very well run into resistance at this pullback resistance level here at 77.82. All right, okay. Excuse me. Okay. Okay, first major resistance for WTI oil would be at about 74.18, right? We see pretty decent pullback support level here again that occurred on 23rd of Jan till 24th of so for a period of about a couple of days, price running into finding decent support here. And it's also a level that aligns quite close to the 61.8% Fibonacci retracement. All right, oh, thank you, Alinda. All right, thank you very much. It's very kind of you. All right. All right. And also, of course, if you may have any questions or any analysis that you would like to be done, do let me know because we've just covered dollar index, the euro, and the pound, and gold as well. So if you'd like me to go through any of that, do let me know. I'll be more than happy to go through the analysis with you again. All right. Okay. So this is what we have for WTI oil here, and do take note, we've got the Bank of England coming up today. So let me just go back to the slides. Right, so we've got the Bank of England releasing their monetary policy report at 12 p.m. GMT time. All right, okay, I'll cover gold after this. Great, okay. We've also got Andrew Bailey, Bank of England Governor Andrew Bailey making his press conference, delivering his press conference at 12:30 p.m. GMT time. So the Bank of England is expected to maintain their official bank rate at 5.25%, but the tone of the report and the communication during the press conference by Governor Bailey could potentially be quite hawkish as well, right? So that could then potentially provide short-term bullish catalyst for the pound. So do take note, we could see the pound bounce following the release of the monetary policy report, as well as during the press conference that's going to take place 30 minutes after. Right, part of the reason is that although they are not going to raise rates, but inflation is still high. We see headline CPI on the left in the UK, core CPI on the right. They're both at 4% and 5.1% year over year, respectively. This is well above the BOE's target of 2 to 3%. So although they are not in a position to raise interest rates right now, they are more than likely to maintain rates at current levels while communicating a pretty hawkish tone. Part of the reason for not raising interest rates is because when you look at GDP growth, this is quarterly GDP growth over the past 18 months or so, growth has been pretty anemic, right? So they do not want higher interest rates, or they don't wish to raise interest rates again, which could then have a negative impact on economic output or economic growth. Right, on the right, we have composite PMI data. So the last 3 months has shown the composite PMI data printing above 50. So this indicates expansion for the manufacturing and services sector. So perhaps Q4 data for 2023 could show a pretty decent growth for the UK. All right, okay, so then so let's just go back to the slides. Sorry, let's jump back into trading view and we'll cover gold. Right, so okay, so just before that, just do take note that for the pound, since we got the Bank of England coming up later today, pound is trading about 1.2650. And this level here has indeed functioned as a pretty significant support level. So if we get a report that's kind of hawkish, and we also see Governor Andrew Bailey communicating a very hawkish tone, we are quite likely, or not quite likely, it could potentially then cause the pound to bounce off this first support at 2650 and climb higher. All right, okay, so with that, let's move on to gold. All right, okay, so here we are. I'm on the 4-hour chart for gold. All right, so as you can see, this level here at 2049 is an intermediate resistance level for gold, where we see price running the resistance here yesterday, which is also a level that aligns quite well with the 78.6% Fibonacci retracement. So this retracement started from here, 12th of Jan, right? We started this retracement from 12th of Jan and ending with this low here on the 17th of Jan. Right, moving up with terms of resistances, we see this zone here between 2055 and 2060 as a very significant overlap resistance zone. We see price bouncing off this level here on 29th of December, 3rd of Jan, and then running into resistance here on 5th of Jan, 12th of Jan, and recently as well. We can argue that on yesterday that price ran into resistance around here once more. Right, so this tells us that this zone is indeed a very significant resistance level, and we also have it also aligns quite well with the 61.8% Fibonacci retracement. So this retracement begins from here, this high on 28th of December, ending with this low here on the 17th of Jan. Right, so this resistance tells us that should we see demand for the dollar drop, right? As we all know, gold prices and the US dollar have an inverse relationship. So if demand for the US dollar drops, we could see gold prices rise higher. And if it breaks above this intermediate resistance at 2049, then we could have a potential bullish breakout. And that means we could see price rise towards this first major resistance. So this resistance zone here between 2055 and 2060 is where we can identify a potential take profit for a potential long gold position. Because right now we do see price in a pretty decent uptrend as well, right? We do see a pretty decent uptrend here. So should price manage to reverse off this ascending trend line, right? If we see price reverse off this ascending trend line, then that may give us a decent opportunity to enter a long position for gold. And especially if it breaks above this intermediate resistance at 2050 or 2050, then we've got a pretty decent chance that price could rise up at least towards 2055, right? So do take note, should price reverse off this ascending trend line for gold, it gives us a pretty decent opportunity to go long. And of course, should price then break above this intermediate resistance, then we can probably target the price zone between 2055 and 2060 as a potential take profit zone, right? To take note of that. And to the downside, we see pretty decent support at 2030 as well, where we can see, let me zoom in a bit. You can see price bouncing off this level for a couple of days on Tuesday and Wednesday. And it's also a level that aligns quite well with the 50% Fibonacci retracement. So this retracement started from here, 25th of Jan, and ended here with the high of yesterday at 31st of January, right? So you can see that we have the ascending trend line here. This would be the first level of support for gold prices, and the next level of support is at 2031. Of course, the next major support for gold is at 2005. Right, we can see very clearly this is indeed a very significant swing bounce here that's occurred on 18 Jan. So this tells us that because of the size of this move or the size of this swing low bounce, that this support level at 2005 is indeed very significant. Similarly, when we look at the second support at 1976, we do see once again the size of the move, right? The fall and the bounce, right? This is a very big or very significant swing low bounce here, right? So this tells us this price level here at 1,976 is indeed a very strong or very significant support level for gold prices, right? This is a very significant swing low bounce. Similarly, just like this here on the 17th of Jan, this is also a pretty significant swing low bounce. All right, so this is what we have for gold prices. And if we see demand for the dollar pick up, especially we've got NFPs tomorrow, right? Friday, 1:30 p.m., 2nd of February. So non-farm payrolls, if we get a stronger than expected non-farm payroll number, that means the US labor market is robust, is growing strongly, and then that usually functions as a bullish catalyst for the dollar. So if the dollar is going to rise strongly, then it's quite likely that gold prices are going to fall. So in that scenario, should we see a very strong NFP number, and we also see demand for the dollar pickup, so that means dollar index, we see dollar index rise very strongly, then it's quite likely we're going to see gold prices fall. So if we do see gold prices break below the ascending trend line as well as this pullback's intermediate support at the 50% retracement, then of course we can target uh 2000, we can target the first support, or we can identify our take profit at around the zone of the first support. So probably between 2010 and 2005 is where we can identify a potential take profit for gold should we see prices break below the ascending trend line as well as the pullback support here at 2031, which is the 50% Fibonacci retracement. All right, okay. Right, we're coming to the end of today's webinar. Right, so do take note, there's been a change in the time for uh, IronFX webinar for this for today for every Thursday rather, instead of what is it? Instead of yeah, instead of 9:30 a.m. GMT, it's now at 9 a.m. GMT every Thursday. So do take note of that. This webinar is now scheduled to run at 9 a.m. GMT every Thursday. So moving forward, do take note that we are starting 30 minutes earlier than usual. All right. Okay. So as we're coming towards the end of this webinar, okay, if there's any requests for any other currencies or commodities or the indices, please do let me know now. Right. Otherwise, I'm just going to launch a poll first, and then once we're done with the poll, I'm more than happy to do one more analysis before we get to it. All right, Alinda. If there's any more, I mean, if there's anything else you would like me to cover, I'll be more than happy to do that as well. Otherwise, yeah, would appreciate it if you could give your feedback as well. And if there's time, we can. I mean, there's time for one more analysis if you wish to look at anything else. All right. Okay. US 30. All right. Great. Okay. Let's cover US 30. Right. I'm going to close the poll soon. So if you could just give your feedback as well, that'd be great. And then I'll cover US 30. US 30 on my chart is Dow Jones, DJ 30. Right. All right. Okay. Right. Okay. So as you can see, we had the FOMC meeting last week. Oh, sorry, not last week, yesterday, because although the Federal Reserve did not raise interest rates, they kept their Fed funds rate at 5.25 to 5.5%. But because they communicated they pushed back against aggressive interest rate cuts. Markets were expecting the Fed to start cutting rates in March, which was the second FOMC meeting of 2024. But instead, at yesterday's meeting, Chairman Jerome Powell pushed back against early interest rate cuts and stated that he would like to keep interest rates at current levels for longer than anticipated. So that created a little bit of shock for the equity markets, right? Especially with tech falling quite hardly. So we can see that this is an intermediate support level for a US 30, or in this case, the instrument that I'm using is DJ 30, right? So Dow Jones 30. So first support comes in at 38,100. This is an intermediate support level, right? We can see price uh running the resist. Very good. Price running into resistance here on 22nd of Jan, 24th of Jan, and then after that finding decent support here on 29th of Jan before going higher. It does once again look to have found decent support here, right? But going into the end of the week after a strong rise in equity markets, right, since 19th of December, January, 22nd of January, prices have pushed quite higher. If we do see this support level taken out, right, today or tomorrow, that is quite likely going to trigger a move. So there's a potential case for a bearish breakout for DJ30, right? So if price does break underneath 38,100, we can then target the first support of 37,800 to 37,900 as a potential take profit zone, right? So when we look across 37,800, this is also another significant overlap level. Why? Because we see it running into resistance here on 1st of Jan, 11th of Jan, and 12th of Jan, and after which, when price broke over, it found support on 23rd Jan, 24th, and 25th. So, right, this creates an overlap level, which is pretty significant. And it's also aligns well with the 50% Fibonacci retracement. So this retracement levels started from here, or this retracement started from 18th of Jan, ending with the high here on the 31st, right? So this is a pretty significant support zone for Dow Jones, right? So should we see this intermediate support get taken out, then of course, we can target, you can identify a potential take profit zone for a short position from between 37,900 to about 37,820. Conversely, should price manage to stay above, because we see the presence of a bullish Ichimoku cloud as well as this overlap level here. So if we see price manage to climb higher, then of course we should be looking at a potential take profit zone around the first resistance, which is at 38,540. All right, okay. Thanks everyone for tuning in today. Do look out for all upcoming webinars by IronFX. And once again, take note, we've got the Bank of England coming up at 12 p.m. GMT time, press conference at 12:30 p.m. GMT time, and then we've got the highly anticipated non-farm payrolls tomorrow at 1:30 p.m. GMT on Friday, 2nd of February. All right. Take care, everyone. I wish you all the best in your trading journey, and I'll catch you all at the next webinar by IronFX. All right, thank you very much, and thank you once again, Alinda. All right, thank you. Take care and have a great trading week, everyone.